Hi everybody, welcome to today's video, and thanks so much for taking time out of your busy schedule to take part in today's webinar. My name is David Aaron of Aaron Wealth Management. I'm an active advisor working with clients right across Canada since 2001, business owners, individuals, and families. When I say active advisor, that means I manage their investments, I do their insurance, I also do their group plan benefits if they're a business owner, but I also am responsible for creating their financial plan. So my clients don't go somewhere else to get a plan and pay, thousands of dollars for a plan. They actually do that with me, but they don't pay that kind of money. It's part of the service that I provide to my clients is doing the actual planning, creating the plan, updating that plan periodically through the year as their financial situation changes. I update their plan. So I'm doing full financial planning with my clients, and it's a great benefit to them that they only have to work with one person. One of the things that I've also been doing in my career was actually passing on my information and my knowledge to other advisors. At some point in my career, over about 6 years of the 20 plus years, actually was a director of advisor development, helping and guiding and developing advisors right from being a new advisor up to 30-year veterans, passing on the information that I've experienced, my knowledge on how to be a great advisor. In fact, my videos, and I have an online course where advisors right across North America are using my online videos to better their education and be a better advisor. So it's a little background on what I've been doing over the 20 years. Now, some of the information you're going to hear today is really, it's new. You may have never heard of it before. And it's likely because you may have been working with an advisor that doesn't have a life insurance license. Now, whether that's somebody at a bank or somewhere else, some of the material I'm going to be presenting today is you have to have a life insurance license to talk about. So if you're working with someone that doesn't have a life license, it's unlikely you've never heard of these solutions. And that's okay, but today you're going to be thinking, how come I've never heard of this before? So get a pen and a piece of paper handy, because I'm sure you're going to have a lot of questions that you'll want to ask me about later on. So why don't we get into this right away? I'm going to just dig into this session, and I think you're going to find it very, very useful. Okay, one of the things that I'm going to share with you is a question that comes up a lot, and that is, well, at least it comes up in my mind, and that is, you're working with an advisor, they're managing your money, and maybe they've done a financial plan, but you have this one question, and that is, do I have enough money to retire? And the one thing that you should not have is this question if you're working with an advisor, because it should be the one thing that they get answered right away. It happens to be the most burning question. It's the number one question, by the way, when I've done seminars, and I'll hand out cue cards to the audience, and I'll say, write down your number one financial concern, and then write down your number two financial concern. About 95% or more is always this concern. Will I have enough money to retire? Or do I have enough money to retire? Or will I outlive my money? That's always the number one question. The number two question is right across the board, the spectrum of financial planning concerns, because the second question tends to be, what is the planning problem that they have that's unique to them? Business owner, how do I take money out of my business to fund my personal retirement goals? Which accounts should I draw down on first in retirement to make sure that I don't pay a lot of tax? Or when should I start taking my CPP? Those are the second questions, and they're unique to each individual. So this is the number one question. So I often say to people when they're thinking about what they should do about it, I say, well, sometimes you just outgrow your advisor, and you might need to change your advisor to an advisor that is actually dealing with your type of problems, or dealing with where you are in your life cycle of investing. Maybe you need to go to an advisor that spends their entire day working with clients in that area. Okay, so what are we going to learn today? Have a look at this. We're going to be talking about the 3-bucket strategy for retirement income success, how to protect your investment gains from permanent loss, how the sequence of returns can greatly affect your retirement income, how I create your financial plan with award-winning financial planning software, and then how I stress test your financial plan for the things you're concerned about, and how to create tax-free retirement income. And so again, you may have some questions around this, so get a piece of paper ready and write them down, because my goal is to actually help you answer some of those questions in this video, or at a minimum, put you on the path to having some of those questions answered for you, okay? So let's get started. Okay, so let's look at some of the common concerns that I've heard over 20 years. When I put these on here, you're probably going to hear your own thoughts. And so let's run through these. Do I have enough money to retire? Will I outlive my money? How long will my money last? When should I start taking my CPP? How much money do I need to retire? How do I pay less tax during retirement? How do I lower my estate taxes? How do I create tax-free income? How do I minimize my estate value? Which retirement accounts should I draw down on first? How can I protect my portfolio from market losses? And how do we begin working together? What's your process, David? They'll ask me, right? So let's begin. I'm not going to be going into all of those questions because that would take forever, but some of the material, obviously you can see that some of those questions are kind of variations of the same question, but I'm going to share with you some really good information. So let's look at the big dog in the park here, and that is, do I have enough money to retire? That's the number one financial concern with just about everyone. So why don't we just tackle that one right off the start? Well, that depends on you, really. It depends on, are you like this couple who is going to get their bags packed and leave for 5 months and stay somewhere else? Maybe you just want to be at the cottage or at the beach and invite your grandchildren to spend some time with you. Or maybe you want to just be low-key, travel locally, low cost, go visit friends in other provinces, just spend time with the people that you care for. The other thing you have to consider is, what about your health? So often financial plans don't address people that have poor health. What happens to your financial plan? And you'll get a financial plan created for you, and it deals with when everything goes perfectly well, this is what your financial plan looks like. But it ought to deal with the other side of what happens when markets don't behave too kindly the way they've been of late. And then what happens if you become ill or disabled and can't work anymore? What happens to your financial plan? You can see here that 55% of the population actually has to stop working because they become disabled. When I say stop working, it means they didn't retire at the date that they thought they would because they weren't able to work because of a health reason. And then another 23%, a quarter of the population, stopped working to care for a family member. So this is not a small number. A lot of people, and just think about your own situation, or think about some of your friends and family members in their situations, and you're going to see how common this actually is. So I'm going to share with you something that's unique about my business, the service that I offer my clients, because it directly addresses this number one question. And why I'm bringing it forward in the presentation is because it is the single most important question that people ask me all the time. So I want to share with you how I begin to get this question answered. So the first thing is, I want you to think about this idea that you don't have to get a calculator out and paper and a pencil and start doing math. You don't have to worry about spreadsheets anymore. You don't have to worry about going and watching different videos, trying to figure out exactly, how long will my money last, or how much taxes am I going to pay, or how much taxes will my estate have at any given point in my life, or when do I take my CPP? You won't have to do that anymore. The moment you begin working with me, something very unique happens, and I'm going to lead you through how easy it is. First thing is, I start immediately creating your financial plan, not months later. It begins right away. As your assets are being transferred for me to manage them, I begin working on your financial plan so that once the money does arrive with me, we have a plan ready to go. We start reviewing that plan. We start actually getting into the details. Now, I'm going to share with you something really cool. I doubt you've ever experienced this. It's a service that it's a rare thing to come across. And I'm about to, pull back the veil in terms of some of the things I give to my clients that people don't get anywhere else. So let's look at this together. It's called a guided retirement planning. And I appreciate your time, because what I'm about to share with you is really unique. So that's why I wanted to bring it forward and share with this. So let's dig into this. I'm going to go right into the website right now, and I'm going to show you an actual planning session with this is a sample client. This is not a real client, okay? But just to give you a sense of how does this all begin, okay? Okay, here we are inside of the software, and this is the beginning part of how you and I would work together. So consider the fact that you and I, we've agreed to work together, and I see that there are some areas where I know I can have an absolute impact on your financial plan, your retirement planning, and we're signed all the documents and you're moving your assets over. And while that's happening, you and I are now working on your plan. And so this is how quickly we can get to getting real close to understanding what your current situation is like and what we're going to need to do in order to affect an outcome where we achieve all your financial planning goals. And why I'm sharing this with you is because you're not going to get this anywhere else. I would be really surprised if you have anyone that's ever led you through this kind of collaborative approach to solving your retirement planning or your financial planning. It's a rare thing. I'm pulling back the veil on some of the services that I give to my clients. This is at no additional cost. This is just some of the detailed work that I do with you. And so watch how quickly, in 4 simple steps, how we get close to answering that number one question, and that is, will I have enough money to retire? Now, this isn't full financial planning. I'll share with you what I do after this, but watch how quickly we get through this, okay? We're going to put in your incomes here. You see, this is a couple. We're actually going to type it in. It's live on the screen. We'll do this during a Zoom call or during a one-on-one meeting in your home or your business, wherever we need to meet. Then we're going to put in your retirement. Okay, so what's special about your retirement? Well, what age do you plan to retire? So we click on this. We say age 65. We're going to live to age 90. And we're going to put in how much of CPP and old age security you're eligible for. So we'll do that for both of you. It's really quick. And you can see the graph starts to appear. And you'll notice on this left side here, where it's early retirement, mid-retirement, later retirement, you'll see some videos on YouTube where people will talk about go, slow go, and no go. That's what this refers to, that your income is higher at first 12 years, and then it begins to drop down because you're no longer as active as it used to be. And then we get to use these great sliders here that say, well, how much money do you need to spend on leisure? And so you just slide it around, and those numbers adjust for you. And then your living expenses, and then we can see exactly, trying to figure out exactly how much money you're going to be spending in retirement. So it's a different approach to that idea of 70% of your income is what you'll use in retirement. We're actually getting some detailed information. Next, number 3, let's put in some accounts. So here we've got RSP, tax-free savings account, and how much they are. And then we'll actually put in how much money someone's contributing. Now I'm putting $6,000. I'm saying that because that's the average contribution in Canada. The average contribution right across Canada is $6,000. So I'm going to use that as an example. So this couple has $330,000 of assets available to them right now. And then the last one is the result. Click on this and watch what happens. It tells them right away they're short on their retirement goal. They're 87% to their goal. So they still have some work to do to make sure that they're funded. You'll notice on the right-hand side, you'll see this red area. That means that's the unfunded. It means they're not able to pay for all of their lifestyle expenses. And it begins to happen really mid life, and that's not good, in the middle of your retirement. This is live with you in a period of probably less than 10 minutes. We'll have gotten to a point where we're probably acknowledging the very concern that you have, and that is you're not sure if you have enough money to retire, and we see it right in front of us. So real time, to get the conversation started, we're going to go explore options, and we'll say, okay, what could we do about this? What if you were to spend 5% less? 5% less. So instead of thinking about your expenses and saying, we could probably do with 5% less in spending, what would that do? Immediately go from 87 to 93%. And then I say to you, well, you don't want to retire later. We're not going to change this retirement date. You want to retire. I mean, the good thing is you want to say, can I retire sooner is what you really want to hear. But then I'd say, well, look, we're only putting $6,000 a year away towards your RSP. Could you put a little bit more? Well, you can see here it actually tells you how much more you need to do. But if we say, could there be 500? Is there more money? Well, $550 gets you 99%. I'll just move that to 600 and you'll see we're at 100%. So in a very short period of time, 10 or 15 minutes on a Zoom call, I know what your situation is and what we can do about it right away. Now, that's not full financial planning. That's just us beginning a conversation. That is you and I being able to bring everything forward, front and center, to know exactly where you are, what your situation is, and what are two things that we could do immediately to bring your retirement to 100%. Well, this is it. Now, the next part down at the bottom right-hand side says promote to level 2. That means start doing full financial planning. Start doing much more detailed financial planning. So things like, what retirement accounts are you going to draw down on first? What age should you start taking your CPP? How are we going to mitigate you having to give back some of your old age security because you have too much income, right? How much taxes do you have on your estate? What if you have other sources of income like pension income? We didn't put that in there. Or rental property income. We didn't put that in there. So that's why I say this is just the beginning part that I go through each client where I share with them, hey, watch how quickly we can get to what we need to do. And then let me dig into full financial planning, drill down and come up with that 20-page document that says, here are the other things that we're going to do to finesse your financial plan to make sure you're giving less money to Revenue Canada, that you're drawing down with the right assets in the right order, and that you're going to be maximizing your estate value to your beneficiaries in a tax efficient way. That's what the full financial planning does. But real quickly, I'm able to help my clients get to that. So that's a really quick way of sharing with you one of the ways that I'm able to help the clients real fast in just one call when we start planning. Then the next thing that I do is I take their financial plan, I just want to make sure you understand it's not that little piece that I did in the beginning. The full financial planning, which is about 20 pages deep, and I boil that down to a one-pager because it's unlikely you're going to read your financial plan, and keep it on your bedside and go to sleep with it. This is something that I do with all my clients, and I give them a financial dashboard. It's a one-page document. It boils down all of your most important goals of your financial plan, and the things that you want to measure, right, and that you want to have an influence on an outcome. And we'll put that on a one-page document. Things like growing your net worth, what's your portfolio rate of return, how much money have I made for you? I think it's important for me to put, the rubber hits the road. Am I making you money or not? Let's put the dollar amount there. Then your total assets. I put that in the center of the page because I think it's important that people see whether they're house rich or whether they're actually investment rich, because it immediately identifies for my client that their retirement plan probably is going to need to include the selling of their principal residence to provide capital for the retirement. So it's one of the things I put center of the financial dashboard. Then their debt. How well are we paying down your debt, and how are we using debt to actually fund some of your assets? So you might have rental properties. That's important. You have debt for that because that's what makes you build that asset. So what kind of debt are we paying down? That's really important. The bottom left-hand corner of the screen is probably the most important part of the financial dashboard, and that is your income. How much income are your assets going to generate for you at your retirement age? And our job together is to grow that number, to get that number higher and higher. And then how much money you have invested currently right now versus how much money you actually need to have invested, because some people think, wow, look, that's a lot of money invested. And then it's a good reminder to say, but you need to get to that number in order to have enough money to last your retirement, given your goals. And then speaking of your goals, the bottom right hand corner, how close are you to actually getting to retirement? Are you on track to retirement? We put the year that you're going to retire right there on the page so we can see visually you're at what percentage. Are you halfway there? So inside of 1 minute, someone is going to be able to see, my client's going to be able to know exactly where they are inside of 1 minute. Every time something materially changes in your life, I update your financial plan, then update the dashboard, and it goes out to you to be able to review anytime. I don't see anybody getting this. This is, again, a rare thing that you get, but all of my clients get it. The next thing I do is I do what's called a Monte Carlo sensitivity analysis. If you're working with an advisor and you have a financial plan, ask them if they can do a Monte Carlo for you. And this isn't an invocation, by the way. This is actually part of the software. Not all financial planning software does this. This is stress testing your financial plan against different variables. So think about different rates of return, different deposit amounts, retiring at a different age, dying early, living longer, rates of return changing. It's stress testing your financial plan against the very concerns that you have right now. And you can see at the bottom, it says alternative 1, 500 trials, it's written there. That means that this has been tested with 500 different variations to all of those things I've just said to see whether or not this financial plan weathers the storms that are possible. And it's saying it's 100%. So if you get something that's below 100%, it's nice to know that there are some things that could impact this financial plan. In this particular case, as a sample, this is showing that this person is at 100%, that this financial plan is sound. So this is a very important thing that I would ask you to measure your financial plan against something that is really vitally important for you to understand how secure and how safe that planning is. Okay, another question I get is when to take my CPP, and there's this retirement zone, age 60 to age 70. What is the optimal age for taking a CPP? And of course, that really depends a lot on you. When you're going to retire, if you need the money, you got to take the CPP. There's the other thinking is that you've been working all your life paying into CPP and like, that money's there, I want it. I want to take it. There's that position or attitude towards taking CPP. And then there's the other position of how does it fit into your financial plan? Do you need the income? Will the CPP actually add to your tax base? Of course it does, but will it push you over a top where you're going to have a clawback? So let's look at this quickly here. The maximum CPP in Canada right now is about $1,200 a month. If you decide, and that's at age 65, if you decide to push it off to age 70, you get a 42% increase. That goes up to $1,709 per month. If you decide to take it early at age 60, you have a 36% reduction in your CPP, and that's about $770 a month. And the average CPP in Canada is $714. So it gives you some insight. If you haven't figured out what your CPP is yet, here's a good idea as to where all the CPP numbers are. Now, one thing that I share with my clients is what's the break even on a CPP. So if you take that blue line, you'll see there going age 60 versus the red line taking CPP at age 65. You see the crossover? The break even is around 72 years of age. That helps people to see exactly when is the break even between age 60 and 65. And people always ask me, if I take CPP early, at age 65, does it begin at 100%? Does it come up? And it's not. It's a permanent reduction in your benefit. The moment you take it before age 65, it's permanently reduced by the factor of whatever age you're taking it at. So you can see that blue line is the least amount of money or the lowest monthly payment going forward as compared to taking it at age 65 or pushing it at age 70. Now, one of the reasons why you would want to be thinking about your CPP and when to take it is the clawback in your old age security. You can see here that begins at income of $79,000, and the moment you're at greater than $128,000, you're no longer eligible to receive your old age security. The maximum benefit is about $648. So those are one of the things that I look for in the plan, is to figure out, let's make sure that we're not giving any money back to Revenue Canada. Then the next step that we go through is reviewing your risk tolerance. Your risk tolerance is really what tells me how much risk can you take in your portfolio and still sleep at night and not be worried about your retirement. And this is really key to understanding exactly the portfolio construction that I need to do in order to meet your emotional goal of being able to live with the amount of volatility in the market and meeting your goal of hitting your retirement plan. So this is important that we get that straight right away. And because one of the questions that people will say about this 4% rule, and that is, if I withdraw 4% of my money per year, how long will my money last? There's this rule, the 4% rule says if I only withdraw 4% of my money, I'll never run out of money. So we're really talking about asset allocation. If you were in cash and you had $1 million portfolio, it would last about 24 years if you withdrew 4% of your money per year. But if you had a 40-60 split, meaning fixed income and equities, it's going to push that number out to age 30. And then if you further diversify that 40-60 split in terms of geography, are you in Canada, North America, and Europe? What kind of bonds do you have? What kind of equity you have? Then you start seeing that money lasts much longer. Now, I'm a goal-based planner. That means that I never receive money from a client unless there is a goal attached to it. So let's talk about what does that mean and why it's so important. The average investor got 2.9% rate of return from 2001 to 2020. And it's because of a few reasons. One is they were either underinvesting or they were trying to time the market. They saw the market going down, they got nervous, they got out of the market, and then came back in at a later time, didn't really time it all that well, and so they didn't really get a great rate of return. Those are a couple of reasons, or they just weren't invested in the right types of investments. They were poor performing. As compared to if you were just tracking the index, like the S&P 500, over that period of time, someone got 7.5% versus also someone that was in a balanced portfolio got 6.4%. So this is important that you need to stay invested and have a really well constructed portfolio. Now, market timing, which I just mentioned a moment ago, if you were invested $10,000 and invested the money, you would see that fully invested, staying in the market despite the volatility, over this period of 2002 to 2021, you'd have a 9.5% rate of return. It would have grown to $61,000. Now, if you had missed the 10 best days and only missed 10 best days of the market, your portfolio drops to 5.33% during that period. That's a lot of money that you missed because you were timing the market. And it gets worse the more days you miss. In fact, if you look at the 7 of the best 10 days occurred 2 weeks of the 10 worst days. And the other thing too, if you look at in 2020, March 12th was immediate. This was the worst day of the year in 2020, was immediately followed by the second best day of the year. So you think about the emotional reaction to a lot of people. You see the market declining, you say, I can't take this anymore, and you get out of the market and you're in cash, and the next day the market goes up. It's the second best day of the entire year. Incredibly frustrating. And that's why you might be watching this video today, is because maybe you've been doing that, or maybe you just want to have sound planning and you want someone that's going to give you some guidance. And I hope you're getting that today. So what does goal-based planning mean? It means that when you are having me invest money on your behalf, you might have a retirement goal. So how much money you're going to need to have at retirement to last through your retirement. You might have an income goal. I want to have a certain income level during this period versus that period, or for an entire 30 years. And you say, how do I invest my money to make sure I always have this income goal being met? Your estate goal. Maybe you're trying to maximize your estate to pass that on to your next generation, to a charity. And so you're thinking, how much taxes am I going to have to pay on my estate? I want to lower that as much as possible. Or maybe, how do I amplify the amount of estate that I have going to my beneficiaries? That's also a goal. Savings goals. Maybe you want to buy some more rental property. Maybe you want to buy another house. Or it's an education savings goal. These are also part of your plan. And then business goals. If you're a business owner and you're investing your money in your business, you have a passive income tax problem, 53% tax going to Revenue Canada. It's a disincentive for you to invest your money. Maybe you're also trying to save money because you want to expand your business or go into different markets or expand into another country like the United States. Or maybe you have a goal of trying to figure out, how do I take money from my business on a tax-free basis to fund my personal retirement goals? These are all goals, and you can understand that or appreciate that each one of these goals has a different timeline, has a different risk tolerance, and has a completely different dollar amount that needs to be going to all those different goals, right? So that's what goal-based planning means. Will I outlive my savings? Well, this is an interesting chart because long ago, in the 80s and the 90s, we had defined benefit plans. Now, those still exist for government workers, for police officers, firefighters. You'll see they have defined benefit plans, but they are really gone, replaced with that red line, which is your defined contribution. So what does that mean? Most of the people who have a pension plan have the weight of retirement is on your shoulders. It's no longer your employer is going to be able to fund that for you, unless you're a government employee or working as a fireman or a policeman, that kind of thing. You're going to have to supply that income. So what does that mean to you? If we were to say that you were looking for a $75,000 annual income, right, because this is your gross income, and you had, with CPP and old age security as a couple, it's just below $40,000 of income, then you need another $36,000. Where's that $36,000 going to come from? That's on the right-hand side, you see that's $3,000 a month that's going to last you through your retirement. $3,000 a month going up at the cost of inflation, and not 4%, not 6%. We're talking about 2% here. That you're getting let's say a 6% rate of return. You'd need to have $750,000 investment at 6% that will produce $3,000 per year, inflation adjusted, for the rest of your life. So that gives you some insight as to who you are right now watching this video and where you need to have a portfolio balance just to provide $3,000. That would be the $36,000 of extra cash they need to come into contact with. Now, we're living longer. This is something you need to plan for in your retirement. So if you've got a couple here and you're 65 today, the chances of you living to age 85 to 75%. It just makes sense that you need to think about your retirement plan in terms of decades, not in terms of a few years. Now, this is that 3-bucket strategy that I talked about in the beginning of our session. What does that actually mean? Well, on the first bucket on the left-hand side, this is where you're spending your lifestyle needs. This is the cash that you use to fund your groceries, your car payments, your gasoline, even your vacations. This is where you're drawing down from to be able to use that money, and that's going to be in cash. That's not from an investment portfolio. Ideally, you want it in cash, because you do not want to be withdrawing cash in a time when the markets are negative. I'm going to get into that in just a minute. So you might want to have 1 to 3 years of cash available for you to draw down on. And then the second bucket is a portfolio that has stocks and bonds, whether you're in a mutual fund or segregated fund, it's equities and fixed income. And you want to be able to have that will supply the capital that's needed for the first bucket, right? So it's not aggressive. It's really like middle of the line rates of return. And then the third bucket is where these are long-term rates of return, where you might want to be a little bit more aggressive with your money because you're trying to produce higher rates of return. And you're just transferring on an annual basis money into each bucket depending on your need for where you need your money. This is a 3-bucket strategy. It's incredibly useful. It's not difficult to do. That's why you use an advisor, so that you're actually having this done for you. Okay, now some people will say to me, David, how do I create tax-free income for my retirement? If you are a business owner and you're trying to create an income stream for you that's non-taxable, you have a problem, because the money that you invest inside of your business, that's not part of your operating expenses. This is the extra money that you have is being taxed at 53%. That's your passive income tax rule. It's a real detriment, a disincentive for you to keep your money in your company and invest it. And then what if you're a couple and you're saying, well, how do I invest my money that's not going to create a clawback on our old age security? So people are really concerned about taxation. And that's what we're talking about, is how do you create an investment that produces a tax-free income stream that doesn't drive up your tax rate? So I'm going to talk with you really quickly about insurance, because this is actually a big topic, and I'm going to just hit the highlights for you. Okay, so investing with insurance, it's a key. It's not the whole thing. It's just a piece to the entire investment portfolio. All the assets that you would use. This is a piece, not the entire thing. I want to make that very clear. Okay, follow along with me. This is actually not difficult. It looks busy, but follow along. I'm going to do this in 2 minutes. Watch. You have an investment. It's like a mutual fund you're using. We'll use that as an example, or a segregated fund, doesn't matter, but we're investing in a traditional investment, $1,000 a month over a 20-year period. That's $240,000 during that 20-year period. You have to pay tax on the growth because this is a non-registered investment. And you grow that, and then at age, let's say 71, you're in retirement. You're going to begin withdrawing money over a 15-year period to supplement your retirement. You're going to draw down $489,000, and the person passes away at age 86. That's the average age of death in Canada. And they've totally expired that account. There's no money being passed on to their beneficiaries. Let's go to the right-hand side. Using a whole life insurance, we call that permanent life insurance. Same dollar amount going in. $1,000 a month for 20 years is $240,000. But the difference here is cash that's invested inside of a life insurance policy experiences no taxation, zero taxation. Same thing at age 71, a person decides to draw down the same amount of money, okay, that the person did in the first example. But they actually could go longer because they had more money to use because they didn't have to give it up to taxation. So they use about $550,000 in tax-free income, no tax, and they pass away at age 86 and give $1.3 million to their beneficiaries tax-free. Now you tell me, this is the part that people say, that can't be right, or what's the catch, or that's got to be illegal. When I present this in seminars, people always ask me, how come I've never heard of this? This is that time, okay, where only people who have a life insurance license can talk about this. And you're not going to have, I challenge you, if you go into your bank and say, can you show me this, that it's probably not going to be a conversation you're going to have. So if you were to put dollar in one and dollar in another and have a completely different outcome, you got to ask yourself, why wouldn't you do the insurance? Why would you continue funding money into a mutual fund or a segregated fund? Why wouldn't you just do the insurance? Well, that's the reason for that is because, one, you can control, right? You can stop and start when you want to fund your money into your non-registered account. You can control how much money goes in and out. You can completely stop it. Life insurance, you got to keep doing it. You got to keep paying it. So it's not for everybody. You need to have capital and sustained capital to keep doing it. But if you are the person who is in a position where you've got enough capital to do this, you are looking at the one of the best planning solutions you could ever do is whole life insurance. So I encourage you to contact me if you have any questions about that. Now, I mentioned earlier about returns, about trying to time the market, trying to get in and out of the market, and drawing down on your investments when there's a negative market. And so we call this sequence of returns. I want you to consider that we're always going to have a crisis. We're going to go from one crisis to another with very brief periods of time where things get calm, and then there's going to be another crisis. Whether it's us making a crisis, like a financial crisis of the real estate market imploding, or where we are now, where we've produced so much money and we have so much debt that now we've got inflation, or whether it's some other crisis where we have not been able to get it out of the way, like a biological crisis or a weather pattern that creates the markets going up and down. We're always going to have some kind of crisis. And if you don't think that's the case, look at this chart. This is such a great chart about volatility and markets. You can see from left to right, there were wars, there were weather patterns, there was Asian flu, there was .com, there was the global financial crisis. This is not new. Volatility is actually quite common. If you see here, this chart tells you the duration of some of these things. The global financial crisis was negative 56% and lasted 1,022 days. The Brexit vote, this is in Europe, was down minus 5.6% and lasted 9 days. Not a big deal, right? But COVID, minus 33%, and we're still going through that. So you think about, you have to be designing your portfolio with the idea that you're going to be fighting some kind of crisis, and your portfolio especially needs to have the Monte Carlo to help you to make sure, is your portfolio going to weather these kinds of events? So whether your money is going up or down, you still have to think about the timing of it. Most people, when you think about markets and volatility, they don't get too upset about it because they know over time markets go up. But we're really talking about what's important to you is when you need your capital. And this is invariably is when someone's going to retire. We call this the retirement zone. The first 5 years, or the 5 years before retirement, and the first 5 years of retirement. You really don't want to have negative returns, severe negative returns, because that impacts your portfolio. Let me show you sequence of returns. This blue line here, the light blue line on the top, represents market gains. So you deposit the same amount of money in the beginning, and over a 10-year period, the annualized rate of return for each one of these lines is 4.8%. But the person who experienced 2 market gains, so that's that light blue line, their portfolio at the end of 10 years, and they're withdrawing the same amount of money every year. Okay, so think about a RIF. You're taking money out of your portfolio or a non-registered account. And the person who experienced 2 years of market gains in the beginning ended up 10 years later with $586,000 versus that dark blue line, someone having 4.8% for the rest of their life and never, or for that 10-year period, it never went up and down, always was 4.8%. They ended up with $537,000. And the person who started their retirement with 2 successive years of negative returns ends up with $472,000. So you can see that in each one of those lines, again, the annualized return for all 3 of those is 4.8%, but they end up with different balances. Now, I want to make sure to say this, and that is none of them ran out of money. It's just they ended up with different balances at the end of 10 years. And it's all about the sequence of returns. And not many advisors talk about this or plan for it. That's why that 3-bucket strategy is really important, because you can put the money you need to spend in cash, and it doesn't really matter if the market goes up and down. That's not going to impact your portfolio to the severity of just leaving it in there and doing withdrawals as markets go down. This is very important for you when you go to retire. Now, pay attention to this. This is one of the most exciting things I want to share with you in this presentation. Protecting your portfolio gains. You may have heard of this. You may have heard of something like this, but I doubt that some of you have actually seen it in action, really in front of you. So let's watch how this works. What if you could actually lock in market gains? Let me share with you what this means. When you experience a loss, it takes time for you to recover that loss. That makes sense, right? But in actual fact, look at this. If you started with $500,000 and you had a negative 20% rate of return, sounds familiar, right? It's happened a number of times in the last few years. And you would have $400,000 after that 20% loss. But you're expecting to get 7% going forward on your portfolio, and inflation's running at 4%, even though inflation is much higher than that right now. But let's say we'll just use 4%. It will take you 9 years to get back to your $500,000. That is what it's like to recover from your losses. Now, you know that if you've been investing for a while, because there was a decade where the S&P TSX went sideways and people didn't really make much money at all. So you understand what it means that it takes time to recover from your losses. But what if you could avoid all that? This is the S&P TSX 2008 to 2022, the actual market volatility over that 15-year period. If you were to put $100,000 in to a portfolio, that dotted line just giving you a reference point of where your 100,000 went in, your original balance, you can see here, these are the periods through that 15-year where S&P TSX was actually gave you a negative return. So you didn't have 100,000, you had less than $100,000. So what if you were to deposit your money and the market goes up, as it did, and you were able to lock in that $150,000 and keeping that guaranteed, so now you have a guarantee of not $100,000, but you have actually a guarantee of $150,000. Even though the market went down, your portfolio was guaranteed to have $150,000. And then when the market actually went up again above $150,000, let's say at $170,000, you locked that in. And then when the market went up to $200,000, you locked that in. And when the market went up to $400,000, I want you to think of December 31st, 2001. Everybody was, look at the amount of money we've made over this 2 years, more than 2 years, but look at how much money we've made. And like that, the market reversed and everyone is like, what happened? Where did my money go? What if you had locked that in and you had guaranteed that your portfolio was at the highest level at that particular time? Would that be valuable to you? Would that make you think differently about how the market is going right now? I know it would, and that's why I'm sharing this with you today, because it's one of the most powerful things you can put into your portfolio. Not everybody has these available. I don't want you to think that I'm the only one that has this. You have to be with an advisor that has a license to be able to do this kind of thing. So this is another reason for you to think about reaching out to me. Now, I'm going to say to you, don't leave it to the last minute. Please don't be in a position where you're retiring a year from now or 2 years from now and you're like, please, you got to do something. Because I don't want to say that it's going to be too late, but the earlier you get started getting answers to your questions, the better off you're going to be. Time is not on your side when you're moving closer to retirement. You need to take action right away and make decisions that's actually going to put you in a position to be able to have the kind of retirement that you want to have on your terms, living the way you want to live, traveling, and really experiencing the kinds of things you're looking forward to. And that begins with getting to someone right away, like myself, to help you start planning. Now, what makes a difference about this session that you may have watched in other areas or other videos, and that is, I'm not selling you anything. There's no program for you to join. There's no email list for you to join. There's nothing here that says you need to buy this from me in order to get something. I'm giving you free information. I'm giving you food for your education, your financial education today. This is what this video is all about. And so here's the process of what would happen if you decided to reach out to me. We're going to jump on a call, and it's going to be a specific, tailored financial planning session. I call it a financial strategy session, and it's really simple. We're going to talk for about 45 minutes, and I'm going to prepare for you based on a lot of the information you're going to talk to me about. This is going to be an exact plan and strategy for you to achieve your financial goals. It won't be something that I'm going to dangle in front of you and say you've got to do this and this and this. I'm actually going to share with you exactly what I would do in order to help you. And why is this important? Because I just believe in telling people exactly where they are. It's something I learned a very long time ago when I started my career. The advisor that was teaching me said to me, always tell the truth to someone about what position they're in and what they need to do. They're going to appreciate actually getting great feedback, great advice. Now, that's the first step. The first step is really making sure that I can help you. Because if I can't help you, I'm going to tell you, here's what I think you need to do. If I can't help you, here's some of the things that you can do in order to get on the right path to being closer to achieving your goal. Because there are some people that I can't help, and I think you can appreciate why. But the idea here is, if I can help you, I'm going to share with you right there on the call exactly what I can do to help. And again, remember that this is a financial strategy session. It's not a generalized conversation. This is you sharing with me your situation and me sharing with you exactly what I think we need to do and how I would go about doing it. It's a powerful session. It's worth the 45-minute time on the call. There's no cost for this. And I like to say there's two outcomes, right? The first outcome is you're actually going to get clear direction on what you need to do. Whether or not you choose to come and work with me is up to you. There is no obligation here for you to work with me. It's just you're going to find out exactly what I believe you need to do in order to get on track and get closer to retirement or hitting that financial planning goal. And the second thing that'll come out of that is you'll know whether or not I can help you or not and what you'll be able to do about it. So you're not leaving that call with a question mark in your mind. You're actually getting the answers. I leave it up to you to decide whether or not you think there's chemistry and there's a willingness where you think that I'm the right advisor for you, because I'll tell you whether or not I can help you or not. This is what you need to do in order to figure that out. So here's the next steps. The first thing is you're going to complete an online information form that's part of this video. And you're going to reserve a date and time with my online calendar. It'll be a one-on-one financial strategy session. And at the end of the discussion, again, one of two things will happen. I'm going to be able to share with you exactly what I'll be able to do to help you. And if I can help you, I'll tell you exactly what I think you could do to get closer to achieving that goal. Now, this probably is going to be the most 30 to 45 minutes of your time you're going to spend on your own personal goals this year. I guarantee you. I've never had anybody after a session think it was a waste of their time. I really believe that if I'm going to allow someone to book time in my calendar, that I'm actually going to sit and be very, very clear about how I can help them. It's one of the most important things I think I will say one of the most important decisions you're going to make this year is booking time with me. Now, I'll just say this, it's a word of warning. And it's going to sound like a sales strategy, but it's not. And it's just pure common sense and logic. There's only a certain number of people I can work with every month, every year. And so as my calendar fills up. I cannot take on more clients and more work than I can possibly do in one given month. So that's why I would say, the early bird gets the worm. The closer you are to achieving your goal is the next step of just getting online and scheduling time. So here's what I would encourage you to do. Hit this button below, get into a strategy session with me, book it as soon as possible so that we can get to work together so I can see exactly how I might be able to help you. And if I can, I'll share that information with you right there on the call. That's it. I hope you enjoyed this session. I hope you got a lot out of it. It was a pleasure for me to share this information with you, and I look forward to seeing you on our Zoom call. Thanks very much, and take care.